We've spent the last 3 episodes building the tools for finding and evaluating mentors: the gap map, the credibility tests, the red flags, and the 30-day trial process. Now we put those tools to work, engine by engine. This episode is about the income engine: what kind of mentor you're looking for, what the mentor needs to be able to teach, and how to assess whether a specific candidate can actually deliver it. The income engine is the most demanding of the 3 engines in terms of the mentorship it requires, and for 2 reasons. First, it's the most technically active engine. It involves executing a trading method in real markets, managing risk on every position, and maintaining consistent discipline in an environment that constantly generates pressure to deviate. Second, it's the most vulnerable to poor mentorship. Following the wrong method in the income engine or following a good method poorly produces real financial losses in real time. The growth engine and accumulation engine have longer feedback cycles, and that gives you more time to course correct, but the income engine does not. What does the income engine mentor need to teach? Well, the answer is pretty straightforward, even if finding someone who teaches it well isn't. They need to teach a specific, replicable method for generating consistent monthly cash flow through active market participation, with risk management built in as a first principle, not an afterthought. So let's break that down. Specific means the method can be described clearly. What qualifies as a valid trade setup, what the entry criteria are, where the stop goes, where the target is, and how to size the position. A mentor who teaches you to look for high probability setups without defining what high probability means in precise terms is not teaching you a method. They're just teaching you a disposition. And dispositions do not compound, but specific criteria do. Replicable means that the method works in your hands, not just in the mentor's hands. A method that depends on pattern recognition developed over years of screen time, or on intuitions that the mentor can't fully articulate, that may be genuinely effective for that practitioner without being teachable to someone at an earlier stage of development. The test of replicability is whether you can apply the method's criteria consistently in paper trading or in live trading, and whether doing so produces results that are meaningfully similar to what the mentor demonstrates. If you cannot bridge the gap between their execution and yours, the method may not be replicable at your current level. And that's information worth having before you commit real capital to it. Built-in risk management means that the method specifies how much capital is at risk on any given trade as a function of account size, and that limit is non-negotiable. Any income engine mentor worth following will address this explicitly and repeatedly, not as a general principle you apply when you remember it, but as a hard rule that's baked into the method itself. The mechanics of how they define the risk limit will vary by instrument and by approach, but the presence of an explicit, consistently applied risk limit is non-negotiable. If a mentor rarely discusses risk management or treats it as a secondary concern relative to finding profitable setups, just move on. Now, there's also a fourth thing that the income engine mentor needs to address, and it's the one that most content creators in the trading space underemphasize: the reality of losing months. Every active trading approach will have months where the method produces below target results, and some months where it produces a net loss. A mentor who only presents their approach in winning conditions, or who discusses losing months so briefly that they feel like anomalies rather than a normal feature of the method, is not preparing you for what the income engine will actually feel like, especially over a 5-year duration such as the $1 million experiment it is going through. The mentor who discusses their losing months in the same level of detail as their winning months, what went wrong, how they managed through it, what the method says to do when the results are poor, they're giving you something that the others aren't: a realistic picture of what long-term commitment to this approach actually requires. Let's look at specific instrument categories, starting with futures. In the $1 million experiment, the income engine uses micro, E-mini, S&P 500 futures contracts as the primary instrument, and we chose this approach for the reasons we described in Module 1: the leverage relative to the capital required, the near 24-hour trading window, and the clean scalability as the account grows. If you're also planning to use futures for your income engine, here's what to look for in a mentor who teaches this approach: The first and most important criterion is that they trade the instruments that they teach, and that they demonstrate this transparently. A futures trading mentor who shows live or recent trade examples with entries, exits, and the reasoning behind each one is demonstrating something that a mentor who only discusses trading in the abstract cannot, that the method works in actual market conditions, not just in retrospective analysis of clean chart examples. The difference between a method that looks elegant on a historical chart and one that generates consistent results in a live, noisy, unpredictable market is significant. And the only way to assess it is to see live or near live demonstrations. The second criterion is that their method is rule-based enough for you to replicate in your own paper trading during the evaluation period. A purely discretionary approach, one where the entry decision depends primarily on experience-based pattern recognition that the mentor cannot fully articulate, that may be effective for them, but it's not teachable to someone earlier in their development. The method needs to have specific criteria that you can apply independently. It does not need to be fully mechanical. Some discretion is present in most effective trading approaches, but the core decision-making framework needs to be something they can articulate and transfer to you. The third criterion is how explicitly the mentor addresses psychology and discipline. Risk management and trading psychology are where most new traders fail, and a mentor who addresses these topics directly and repeatedly, not just the mechanics of when to enter and where to set a stop, but how to handle a losing streak, how to avoid FOMO, fear of missing out based or driven entries, and how to maintain the discipline to follow the method when it does not feel like it's working. They're teaching the complete set of skills that the income engine actually requires. A mentor who focuses almost entirely on setups and entries and rarely addresses the psychology dimension, well, they're only teaching you a part of the method. A fourth criterion that's specific to futures is transparency about the relationship between the trading time frame and the time commitment the method requires. Futures trading spans a wide range of styles, from rapid scalping approaches that involve many short-duration trades across a session to more deliberate, swing-oriented approaches that involve fewer setups and more waiting. The time commitment, the pace of decision-making, the psychological demands, they're very different across that range. The mentor's content should make it clear where on that spectrum their method sits. If it doesn't, you're not going to know until you're in the middle of a 30-day trial whether the pace is one that you can sustain. Given that the $1 Million Experiment's own experience involved 2 mentor trials before finding an approach whose pace was a genuine fit, it's worth asking this question explicitly before you start. And we'll talk more about those 2 challenging mentor trials a little later on. Beyond futures, the income engine can be powered by other active trading approaches depending on the investor's situation, schedule, and preferences. Active equity trading, buying and selling individual stocks on a short-term basis to capture directional moves, that's a common income engine approach, particularly for investors who are more comfortable with equity markets than with futures markets. The mentor evaluation criteria are essentially the same: demonstrated live results, a rule-based replicable method, and explicit treatment of risk management and psychology. The main difference is that equity trading typically has a lower capital barrier to entry and does not require a margin account, which makes it more accessible for investors starting with smaller amounts. One thing worth noting about equity trading as an income engine approach, the universe of tradable instruments is much larger than in futures, which means that the method needs to include a specific stock selection or screening process on top of the trade execution criteria. A futures trading mentor primarily needs to teach you how to trade 1 or 2 instruments well, but an equity trading mentor needs to teach you both how to trade and how to identify which stocks are worth trading at any given time. Look for equity mentors whose method includes a clear, repeatable screening process, not just trade execution criteria applied to whatever happens to catch your attention. Forex trading is another income engine option that attracts practitioners who prefer the liquidity, the 24-hour access, and the leverage characteristics of currency markets. Forex mentors vary enormously in quality, and the space has historically attracted a higher proportion of low-quality content and outright fraud than other trading categories. So, the credibility tests from episode 12 apply here with particular force. Look for mentors who demonstrate verifiable live results, teach a specific rule-based method, and address risk management explicitly. Be especially cautious of forex mentors who emphasize large potential returns without equivalent emphasis on the risk characteristics of leveraged currency trading. Regardless of which instrument or approach you've chosen for your income engine, there are a small number of characteristics that every effective income engine mentor will have in common. And these are not instrument specific. They apply whether the mentor teaches futures, equities, forex, or anything else. The first is that they treat risk management as the foundation, not as a feature. The best income engine mentors talk about risk management the way a structural engineer talks about load-bearing walls, not as one consideration among many, but as the thing that everything else is built on. They define the risk per trade as a function of account size. They discuss what happens when the method's not working and the account is in drawdown. They address the psychological challenge of continuing to apply a risk rule when the emotional pressure to make it back is at its strongest. A mentor for whom risk management is a topic they cover periodically in between setup discussions is not prioritizing it appropriately. The second is that they demonstrate the method over time, not just in hindsight. Anyone can find historical chart examples that make a method look elegant and profitable. But what's much rarer is a mentor who shares their results in something close to real time, documenting their trades as they happen, including the setups that they pass on and why, the entries they take and the exits that they follow, and the overall monthly performance against a stated target. That kind of running demonstration is not just valuable as evidence that the method works, it's also valuable as a teaching tool because it shows you what it looks like to apply the method in conditions that are imperfect or ambiguous, and that sometimes when they're adverse, which is, and frankly, it's the only kind of conditions that really exist. The third is that they teach the method at a level of detail appropriate to where you're starting from. A mentor who assumes significant prior knowledge, who explains setups using jargon without definition, or who moves quickly through the mechanics of position sizing as though they're obvious, well, they may be effective for practitioners who are already past the basics. But for someone building the income engine from an early stage, what you need is a mentor who can explain why each part of the method exists and what problem it solves, not just what it is. There's one more characteristic worth naming, and it's one that the evaluation framework from episodes 12 and 13 is specifically designed to surface. The best income engine mentors are ones whose method produces results in your hands, not just in theirs. The 30-day evaluation process, paper trading the method in week 2 and attempting small live execution in week 4, that's specifically designed to test this. A method that looks clean and compelling in the mentor's demonstrations, but that you cannot apply consistently in your own paper trading is not yet the right method for you, regardless of how credible the mentor is. The fit between the method and your current level of development, your available time, and your psychological profile, that matters as much as the quality of the method itself. This point has a specific implication for how you shortlist candidates. Before running the 30-day evaluation, look at the mentor's foundational content and ask whether it's directed at someone at your level. A mentor whose basic content assumes prior trading experience will be difficult to evaluate fairly during the trial period if you're starting from an early baseline. You want the method to be challenging enough to develop your skill, but not so far above your current level that the paper trading phase produces confusion rather than learning. The gap map tells you what you need. The trial process tests whether this mentor can provide it. But your shortlisting should filter for candidates who are teaching at a level where the trial will actually produce useful information. Now let's talk about how the $1 million experiment approached the income engine, because it illustrates something useful about the selection process. Now we chose futures, specifically MES, Micro E-mini S&P 500 contracts, for a very particular reason. Futures scale exceptionally cleanly as the account grows. One contract at a $3,000 account becomes 2 contracts at $6,000, 3 contracts at $9,000, and so on. The leverage characteristics also mean you can generate meaningful returns from a relatively small starting account, which matters a great deal in the early months of the $1 million experiment when the income engine is still building towards scale. That combination of clean scalability and capital efficiency made futures the right instrument for the million-dollar experiment's specific design. Finding the right mentor for that approach took longer than we were expecting, and the process produced a lesson that's worth sharing. The first two mentors we trialed both taught legitimate futures trading methods. The problem was style, not substance. Both approaches were built around a rapid-fire scalping model, short time frames, quick in and out trades, and a pace that required intense focus and fast decision-making throughout the trading session. The methods were valid, but for us, the pace was simply too fast. It did not fit how we wanted to operate the income engine, and we found ourselves making decisions under time pressure that we were not comfortable with. It was only when we trialed a third mentor that the fit became clear. The approach was still active, it still required real attention and real decision-making, but the pace was one that we could sustain comfortably. The setups developed at a speed that gave us time to think clearly rather than react instinctively. The lesson from that experience is straightforward. When you trial an income engine mentor, pay attention to not just whether the method is technically sound, but to whether the pace and style of execution feels sustainable for you over months and years, not just over a few days. A method that you cannot maintain consistently is not the right method for you, regardless of how good it looks on paper. The resources page at theinvestingproject.com lists the categories of guidance that we found most useful for the income engine. Use it as a starting point. Run every candidate through the 30-day trial and use the criteria that we've covered today to assess what you find. The right mentor for you is out there, but finding them may take more than one trial, and that is completely normal as part of building your virtual investing organization. Now, to recap what we've covered, the income engine mentor needs to teach a specific, replicable method for generating consistent monthly cash flow through active trading, with risk management built in as a non-negotiable foundation, not just as a secondary topic. That requirement holds regardless of which instrument you're using, futures, equities, forex, options, or anything else. What distinguishes a genuinely useful income engine mentor from one who appears credible but falls short in practice is the combination of demonstrated live results over time, a method specific enough to apply in your own paper trading during the evaluation period, explicit and repeated treatment of risk management and psychology, and a teaching style that produces real skill development rather than ongoing dependency. Apply the 30-day evaluation process before committing and assess the result against these criteria before, rather than just against how impressive the mentor's content feels in isolation. And be especially careful with income engine mentors about confusing presentation quality with method quality. The investing content space has a higher density of polished, confident presenters than it does practitioners with genuinely replicable, risk-managed methods. The credibility tests and the 30-day trial exist specifically to separate these two things, because one of them will develop your capability and the other one won't, regardless of how similar they look from the outside. The next episode covers the growth and accumulation engines, what kind of mentor you're looking for in each of those engines, how those mentor relationships differ from the income engine mentorship, and how the overall virtual investing organization comes together across all three engines, and the support functions. After that, we're going to close Module 2 with a look at our own virtual investing organization, the types of mentors we chose for each engine in the $1 Million Experiment, the criteria we used, and the evaluation process and what it looked like in practice. So remember to like and subscribe so you don't miss it, and we'll see you there.